Welcome to the Three Edge Week in Review for the week of April 18th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today once again is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. In today's Three Edge Week in Review, Steve and I will be discussing why, after a very difficult first quarter for both stocks and bonds, some people on Wall Street are calling for the equity markets to rally from here, and the possible that equities could even experience a market melt-up. As you can probably tell, I'm not at my usual location this week. I've been out traveling in the Salt Lake City area, having a chance to meet with the advisors who use our Three Edge solution on behalf of their clients. It's been terrific to get back out on the road, and advisors have been expressing how appreciative they are that the Three Edge strategies have held up this year. So let's get to it, Steve. As we know, this has just been a very difficult start to the year here in 2022 for both stocks and bonds. Certainly no shortage of difficult news out there. We have Russia's invasion of Ukraine, inflation at 4-decade highs. You have China, a COVID lockdown in Shanghai. So perhaps it would be helpful if you could describe, well, what exactly is a market melt-up and what could cause such a thing to happen?
Well, Fritz, a market melt-up refers to the idea that the market accelerates to a new all-time high in a spectacular fashion, creating more and more buying in the process as investors hate to be left out. And some analysts now are calling for such a major rally, saying that investors have been too gloomy and that any positive surprise could spark a melt-up. Perhaps there's a surprise ending to the Ukraine-Russia war. Perhaps inflation unexpectedly comes down, and that would relieve the Fed of a major tightening phase. Perhaps company profits continue to set records and are impervious to any outside pressures. We've studied every market bubble in history, and we know there are several cases where, despite the odds, the market ends with one last spectacular rise before succumbing to the fundamental and economic constraints. And from time to time, the market doesn't always follow the most logical or reasonable course of action. So one should always be humble and think outside the box and be prepared for the unexpected. If we look at the accompanying chart, we see that the extraordinary monetary stimulus has continued right up through the last month. And we know that companies are still buying back record amounts of their own shares. We know that the bond market continues to suffer, and some of that money leaving bonds is going back into stocks. And we also know, especially with the retail investors, that the buy the dip mentality is still there. So in the short term, markets can be driven not by logic or common sense necessarily. Sometimes it can just be driven by emotion and the roar of the crowd. And in the short term, it ignores a lot of the fundamental aspects, even though, as the chart shows, that all these supporting forces, none of them are really that sustainable.
Right. Great. So one thing that there has been an inordinate amount of discussion around recently is the idea of the yield curve and how the yield curve is flattening. And we know that the flattening of the yield curve, generally when you have short-term interest rates that are higher than long-term rates, that can be an indication that economic weakness or even a recession could be on the horizon. However, I know that at Three Edge, we have a somewhat more nuanced approach to analyzing the shape of the yield curve. And I think maybe it'd be helpful if you just maybe explain that a little bit. And the important thing there is that actually is one thing that could be at least one factor that is positive or potentially positive for U.S. equities in the future, at least in the short term.
That's right, Fritz. So our research clearly shows that the traditional way investors measure the yield curve, which is to compare the 2-year Treasury yield with the 10-year Treasury yield, is not as effective in predicting recessions or market corrections as comparing the 3-month Treasury bill yield with the 10-year. So we read, as you mentioned in the news, how everyone's talking about the yield curve's inverted and so on. Well, the way we measure it, no, it's still far from being inverted. However, having said that, our research also shows that it's just not sufficient to look at the slope of the yield curve. It's equally important to look at the change in the slope of the yield curve. And there's no question that the yield curve, even though we're saying it's still quite steep, there's no question it's starting its flattening process. And with everything the Fed has indicated, that flattening process should only continue and maybe even accelerate. So this is a way of saying that a recession is out in the future. It might be more delayed than people might traditionally expect, but it's not necessarily going to be averted.
Excellent. So as always, my last question to you is based on what we've discussed here today, the possibility of an equity market melt up, at least potential for one. How should investors then think about their positioning their portfolios here early in 2022?
Well, we don't think now's the time to chase a market bubble or a melt up. We think it still pays to remain cautious, and we will continue to do that because valuations are elevated. Inflation's at 40-year highs. We've got lots of geopolitical uncertainty, as you mentioned. And now we have a Federal Reserve Board that completely changed course, even though they've been very late. They're not only raising interest rates, but they're shrinking their balance sheet, which I think will have a bigger impact than most people expect. Having said that, if an investor today was completely out of equities, and we've seen this in past cycles, and equities were to experience one last rally, for those investors, the pain of missing out can be so great that they can't resist the temptation to just throw in the towel and just get back in the market. And often, we've seen in history, people have done that right at the top, just before the next big correction. And after a market melt up, if we do have something like that, then the market meltdown is even more serious. So at 3Edge, we are maintaining a defensive allocation to equities. We are above our minimums, and our models have suggested to stay defensive, but above our minimums right now. What that means is that if we do get a future rally, we can participate somewhat. And the equities we have are tilted toward more relatively undervalued and more dividend growth equities, and those have outperformed year to date. So we think that's good. This way, we're not overly exposed until the time when our research guides us to become even more defensive, perhaps down to our minimum. And when that happens, we'll take action.
Excellent. That's a great description, and I think it sheds light on how our approach oftentimes is quite nuanced. It's neither black nor white, but there are these gray areas where you really need to navigate to be a successful investor. So thank you very much. That will do it for Steve and me. Remember, all of our videos are available on our 3Edge YouTube channel. And in addition, all the videos and our written commentaries are always available on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.